You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast. We're doing something a little different in this episode. We're in episode 5 of about a 100-part series designed to walk through macro fundamentals from the ground up. If you're new to the world of economics, trading, or policy, this series is built for you. This episode is called Don't Force a Narrative.
Right, and today we're focusing on something, well, incredibly frustrating that happens when you're watching the markets. You know, those sudden sharp price moves, like, say, a 40-pip spike just pops up in the euro dollar. But there's absolutely nothing alongside it. No headline, no data release, no central banker speaking anywhere, just movement.
Yeah, silence drives you crazy.
It does. And in today's market environment, which is, let's face it, high speed, pretty volatile, knowing how to tell the difference between a real signal, something you can identify, and just pure noise. Well, that's critical. It's about preserving capital, really, and sticking to your strategy.
Okay, so today we'll unpack that basic human trap, that need we have for an explanation for everything. We'll also reveal 3 sort of invisible non-macro drivers that can really move prices. Stuff the pros watch. And we'll give you a pretty powerful new rule for those times when the charts just, don't seem to make any logical sense.
That's good.
Okay, let's unpack this. So we've all been there, right? You're sitting at your desk, charts are up. Maybe it's that quiet patch, mid-morning London time, or maybe just before the U.S. opens. News flow is dead.
Yeah, nothing scheduled, nothing breaking. Crickets.
Exactly. And then, boom, out of nowhere, the chart just moves. Maybe gold suddenly drops $50, or S&P futures lurch higher, like some invisible hand just shoved the market. And what's the very first thing you do? That gut reaction.
Oh, yeah. You're mashing refresh on your news feed, right?
Yeah.
Gotta have a headline. There must be a reason.
There must be. It's like an itch you have to scratch.
It really is. And that impulse, it comes from something deep down. Humans, we crave cause and effect. We really don't like randomness. It makes us uncomfortable.
But the market, it doesn't always play by those rules, does it?
Not at all. It's messy. It can be chaotic. So when the price moves, especially if it's a big, sharp move, our brains instantly start, well, telling stories. We do it to make ourselves feel better about not knowing the why. We swap that uncertainty for, well, sometimes flimsy conviction.
Yeah, flimsy is a good word. We become instant storytellers. And the logic doesn't even have to hold up, does it? You hear people say things like,
Oh, all the time. It must be a delayed reaction to that CPI number from Tuesday.
Or maybe the market's just now realizing that Fed guy yesterday was actually hawkish.
Exactly. It's this immediate jump, almost desperate to find any explanation that fits what you just saw on the screen.
And that desperation, that's the trap, isn't it? The trap of the overanalyst.
That's it, precisely. It's the dangerous assumption that every single little tick, every price move, has to have some identifiable macro cause you can label. And if you think like that, you end up chasing shadows. You start trading based on ghosts, basically.
Mistaking noise for a real signal.
Pure noise. Stuff that's just mechanical, not fundamental.
Okay.
And you have to accept a simple truth. The market doesn't owe you or me or anyone a headline for every single move. It just doesn't.
I wonder if people truly accept that, though. I mean, you see a huge spike. Isn't it just easier to think, okay, I must have missed a headline, rather than accept it might be random flow?
It is definitely easier mentally, but it's a dangerous path for trading. Remember we talked about that gear analogy before? Thinking of the market like a machine with all these interconnected gears, policy, data, sentiment, positioning.
Right, yeah. Like when a central bank hikes rates aggressively,
Right.
That's the policy gear turning, obviously.
Exactly. It dominates. Yield spike, the currency moves. It's clean. You can trace it back. Cause and effect.
The driver is clear.
But, other times the movement is much more subtle. Maybe it's a combination of smaller gears turning. Or maybe the movement is driven by something totally invisible from the outside. Just because the machine is running and price is changing doesn't mean you'll always be able to point and say, that gear caused it.
And not spotting the gear isn't necessarily a failure on our part.
Not at all. That's the crucial point. It's not a failure of your analysis or your intelligence. It's just acknowledging that the market has these complex, sometimes hidden mechanics. You have to respect the invisible forces at play.
Okay. So let's move away from the psychology for a sec. Let's get practical. If these mystery moves aren't always driven by the Fed or inflation or big news, what is driving them? What are these invisible drivers, the things the pros know about?
Okay, yeah. We need to shift our focus here. Forget the public macro news for a moment. Everyone sees that. We need to look at specific, often hidden, micro-level actions. Things that are big enough to move major markets, currencies, indices, commodities, but happen, behind the curtain. I tend to group them into three main categories.
All right, let's hear them. What's the first one?
Driver number one, mergers and acquisitions, M&A. This is a really big one, especially for the FX market.
Right, corporate deals.
Exactly. Imagine a huge European company finally closes a billion-dollar deal to buy a U.S. tech firm. Let's say it's a multi-billion-dollar deal. Now, to make that payment, they need dollars. So their bank or their treasury desk has to sell a massive amount of euros and buy U.S. dollars.
Ah, okay. And the key is when that trade actually happens, right?
Yeah.
The merger might have been announced weeks ago, but the currency flow hits later.
Precisely. The news is old, maybe weeks old. But the physical conversion, the actual trade, hits the market desks, often in big chunks, when the deal closes or whenever they decide to execute. So to you watching the screen, the euro-dollar just lurches, seemingly out of thin air.
While you're busy looking for some German data release or something.
Exactly. You're scanning the headlines for macro news, but the real driver is a massive corporate finance transaction. It's just sheer size hitting the market, creating these ripples.
Okay, that makes a lot of sense for those sudden currency jumps. Got it. What's number two?
Number two sounds a bit old school, but believe me, it still happens surprisingly often. Fat finger errors.
Really? Even with all the algos and safeguards?
Yep, human error. A trader at a big institution, maybe they're rushed, maybe distracted. They accidentally hit an extra zero on the order size. Suddenly, a planned $1 million trade becomes a $10 million market order.
Whoa.
Or they mix up market and limit order types. Or just hit buy when they meant sell. It happens.
And that's the source of those insane, super short-lived spikes or mini flash crashes, where the price snaps back almost instantly.
That's often exactly it. You see the euro-dollar suddenly plunge 30 pips. And a pip, for anyone new, is just that smallest unit of price movement in currencies. Your first thought is, what did the ECB just say? But really, it was just someone, hitting the wrong key.
And the firm usually catches it quick and reverses it.
Almost instantly, yeah.
Yeah.
They try to undo the mistake, which causes that whipsaw back-and-forth volatility.
Yeah.
And meanwhile, everyone watching is trying to invent some temporary reason for the initial move, only to see that reason evaporate seconds later.
Yeah.
It's pure, unadulterated market noise.
Okay. Fat fingers.
Yeah.
Got it. What about the third driver? You said this one's more subtle.
Yeah, number three is stealth execution by large players. You called them whales earlier, which is a pretty good term.
Right, the big funds.
The big funds. If a portfolio manager decides they need to buy, say, $500 million worth of crude oil futures or shares in an index, they absolutely cannot just slam that order into the market all at once.
Because that would push the price way up against them, right? Slippage.
Exactly. Can you explain slippage just quickly?
Sure. Slippage is just the difference between the price you expected to trade at and the price you actually got filled at. If that huge order hits instantly, it eats up all the best offers, and the rest fills at much worse prices. It kills their average entry price.
Absolutely catastrophic for their performance. So what do?
They have to hide it. Go stealth mode.
They do. They use sophisticated algorithms to slice that massive order into maybe thousands of tiny little pieces. They feed these small orders into the market very quietly, often through multiple brokers, sometimes over hours, maybe even days, trying to blend in, essentially.
So to us on the outside, what does that look like?
It looks like a slow, steady, almost relentless creep in one direction. A gentle, unexplained trend forming. And we're sitting there scratching our heads thinking, what underlying news am I missing? Why is there this constant buying pressure? There's no specific headline driving it. It's just enormous size being worked into the market very carefully in silence.
And that silent, persistent move, that's often what makes us feel like our invented story, our flimsy narrative from earlier, must be right after all. We confuse that mechanical flow with some deep fundamental reason.
You've nailed it.
Yeah.
And that brings us to the crucial part. The playbook for restraint. This is what separates professionals from gamblers, really. Look, it's good. It's necessary even to ask, why is this moving? Curiosity is healthy.
Yeah.
But the danger comes when you answer that question with made-up logic, just to make yourself feel better about the uncertainty. The moment you do that, you're not analyzing anymore. You're just guessing.
So we have to draw a really firm line there. If you start justifying trades based on stories you invented, well, your whole risk management goes out the window.
Absolutely. So let's state the core rule, the one that has to guide you. If you don't know what specific verifiable thing is driving the market right now, whether it's policy or data, or maybe even just a technical positioning thing, then you cannot possibly know if that move has any reason to continue.
Simple rule then, no edge, no trade.
That's it.
And the consequences of breaking that rule, they're serious for risk management, aren't they? If I jump into a trade thinking some fat finger spike was actually, I don't know, ECB comment, how do I even know where my stop loss should be or what would prove me wrong?
You're flying completely blind. You can't define your risk properly. You don't know what news or event would invalidate your reason for being in the trade because your reason wasn't real in the first place. You're basically just betting on momentum continuing without any context. And when it stops, you're stuck. No logical exit plan.
So the actual plan, when you see that crazy jump in the euro-dollar, no news attached, the professional response is, well, kind of counterintuitive for someone who wants to be active.
It is. The response is, sit still. Watch. Don't chase it. Don't immediately jump in. And please, do not manufacture confidence you don't actually have based on real information.
This goes back to that idea you mentioned, not trading is a position.
It absolutely is. And sometimes keeping your powder dry, conserving your emotional energy and your capital by sitting on your hands. That is the single best, highest performing trade you can make that day. It takes discipline.
Yeah, real discipline. And it connects back to process, doesn't it? We want simple analysis that helps focus, but not too simple.
Right. Simplicity is good, but don't oversimplify to the point of caricature. The market isn't always neat. It's the messy result of millions of decisions every day. Some rational, some not, some purely technical, many totally hidden from public view. You don't need to force every little market twitch into a simple box like, oh, that's hawkish or that's dovish. Sometimes it's just noise.
Acknowledge the complexity, but don't feel forced to trade it unless the picture actually clears up.
Exactly. Wait until a verifiable driver emerges that actually aligns with your strategy and your analysis.
Okay, so the final takeaway here, the real power of restraint. It's about understanding why.
That's the core of it. The difference between someone who consistently makes money over the long run and someone who just guesses. It isn't really about having a perfect win rate. Nobody has that. It's about knowing, truly understanding at a fundamental level why you put the trade on.
And when the stars do align, when the macro story is clear, the theme is strong, the drivers are visible.
Then you'll be ready. You'll have the capital, you'll have the emotional balance, precisely because you didn't waste it chasing ghosts during the noisy periods. You waited for your edge.
Patience and process. Powerful stuff.
It really is. Well, thanks for digging into this aspect of market structure with me.
Yeah, great discussion. And appreciate you tuning in to the Financial Source podcast. We'll catch you in the next one as we continue the series on macro fundamentals.